no one shows you the struggles or the time it took them to actually build the wealth that they've had. No one takes the time to think, and how did this person actually get to this kind of wealth? Everyone just wants the next big thing, And so I think the best way to move forward would be to shift our mindset and to actually understand that in investing, it's not about avoiding risk, because there's no investment that does not have a risk.
Yeah.
All investments will either have a low risk, a medium risk, or a high risk. There's nothing like zero risk,
Yeah.
So investing is about managing risk rather than avoiding it. Let's shift our mindset and understand that concept. Understand the risks in every asset class before you actually start investing in it.
Yeah.
Make sure it aligns with your goals.
Hi, and welcome to another episode of Make Money the podcast. Now today we would like to talk about time. And without further ado, noting that time is limited, we'd like to jump straight into this conversation. And we'd like to talk about time in investing, and knowing that time equals money, it's important to know the value that time can deliver on your investment. And I'm happy to be joined by Purity Wanjiru. Purity Wanjiru is a research analyst, financial markets and investments at Abojani Capital. And your background is in financial engineering.
Yes.
I don't know how much of engineering you've done with time, but we'll dive straight into this conversation. And I would like to point you out to, one of the tweets I saw you guys at Abojani put out, just in recent days. And I think without really reading it, word for word, paraphrasing, you talked about, investing not being for the faint-hearted. And you talked about a person who opened a money market fund account with you guys, and within 3 days they're already asking about the returns and why they are not growing as fast as they would have wanted that to be. And myself, in my own experiences, I've also had a situation where someone has reached out and asking about a certain MMF. How come I put 5,000 shillings in this thing, it's not growing as fast? It's been 2 months, the interest I've been getting is perhaps not within expectations. And so I just thought it's good to understand time and the impact time has on your investment, so that you choose between, is it 2 days or is it 2 years for you to see your return. And I think the first question for me is, why do we often perhaps lack the patience? I know it's as much as it's a question on finance, but very much psychological in this instance. A lot of money, a lot of asset classes or investments will grow left alone. If today I invest and leave that money alone, it will actually grow. But somehow we find ourselves sabotaging the process in that I'll stop, I'll doubt, is it growing as fast as I wanted to? They promised 10% return. Is it too much? Is it too little? How much principal did I put out? Where the lack of patience yet sometimes is as easy as putting your money somewhere and your fixed rate of return, or where your return might be, and just leaving it alone. How come we struggle so much to get to that?
Good question. Thank you, Kefa, for having me here today. I'm Purity from Abojani Investments.
Yeah.
The issue of patience, and the reason even why we shared that tweet a few days ago, is because we are actually seeing that issue in the market where people or retail investors actually are making investments, but they're very quick to leave the market before maturity. So I think one of the reasons why people actually lack the patience to stay in an investment or to stay locked in the investment is due to psychological barriers. And a good example is FOMO, or what they call the fear of missing out, and mostly also societal pressures. We have seen, in the digital era, there's a lot of or a constant stream of information, and it's very easy to feel to have anxiety and lack the patience to actually stay in the investment for the long run. And we're actually seeing novice investors or beginner investors, or actually just new investors. They make the investment and they're already conditioned to expect quick returns or overnight success, and that's why we see a lot of scams and all that. So a beginner investor with the wrong mindset, first of all, and with biases like FOMO and all this pressure that you're seeing on social media, they come with the wrong expectations in the investment. And even before maturity, or you find someone is investing and then they just want to keep watching that investment, and in the process they sabotage their journey and they're not able to actually realize the full potential of their investment. It's an issue. It's just a mindset that we need to actually change.
Have you yourself struggled with this mindset? I mean, we as an individual, have you come across a point where you'll have the same struggles as you might see with retail investors as yourself.
I think with my background
Yeah.
in finance, I've always studied investments. I've always studied what people are doing, and I've seen success in the long run. It's something that I've grown up knowing that there's nothing like overnight success, and I have seen it here in Kenya. Everyone who goes for overnight success, it's usually a scam most of the time, and it's a downfall. So for me, I can't say I have struggled with being patient in my investment. I accepted my situation. I started small, and it's a continuous journey of learning and learning stuff, relearning new things.
Yeah. So we would like now to apply some time into whatever investment people are making, and there are quite elaborate formulas out there. But I just chose two to look at, and before we get to the second one, the first one is around compound interest. And I know this is something, you'll explain what compound interest. I'll let you do that as the expert.
Yes.
But ideally, if a working example of 50,000 shillings, and at least now rates are quite favorable, so 10% wouldn't be far-fetched to think about. If I can make a 10% return on an investment and let that money sit there for maybe the next 5 years, earning at 10% per annum, and assuming this is payable only once a year, perhaps give us a sense of how much money I would have at the end of the period, just doing nothing more than letting my 50,000 sit and wait.
Okay. So perhaps let me start by explaining what compound interest is to the layman listener. So compound interest is what is actually your money working for you. We spend a lot of time working for money. You go to work every day, you work overtime, you work on the weekends, that is you working or sacrificing your time for money. So compound interest is the other way around. It is your money that is now working for you. I know this is something that you're seeing in the markets. People I would rather work for money than just let the money work for them. So compound interest is just you letting the money grow itself, and your interest continues earning interest on that interest, and allowing your money to grow exponentially over time. And I like the example that you're giving, that you just make an investment, 50K, as you said. 10% is a good rate. If you leave that money for 5 years, that money would grow to about 80,000. So that's an interest of around 30,000.
So you'd almost be doubling that money. Almost. This important point here.
5 years. But if you hold that money for longer, and there's the rule of 72, that helps you to calculate how much it will, or how long it will take you to actually double your money. So if you divide 72 by that 10, you'd get 7.2 years. So if you hold that money just for 2 years longer, then you'll double that money. You see, so that really shows the power of compound interest and letting your money work for you. If you leave the investment by year 5, you have only made 30,000. If you leave the investment 2 years later at year 7, then you've doubled your investment. You've made an extra 50,000. That is the whole concept of compound interest, that do not have sticky fingers. Let your money rest. Let it work for you. It's not just you working for money, but sometimes just let the money do its thing. Let compound interest work its magic.
And I did like the example. I mean, the point you made here in letting the money work for you, like you said, a lot of people will go hard, grind. But if you're not investing your money and letting the money, offload some of your workload, then you will tend to work almost forever, because you never let your money work, in a sense. So before we go to the rule of 72, which is a little bit simpler, I might say, maybe how does someone assess, without getting really into the formulas, how does someone assess how much compounding you can get from compounding by leaving your money sitting in account? Do you have a simpler way? I know there's a whole formula to it. I wouldn't want to go, as far as turning this to a math class, but I would like to have a sense for someone wondering, maybe you are looking at whatever the investment is. It could be a money market fund, it could be a bond, and you're letting that sit over time and trying to calculate your returns from it. How do we go about, just making an assessment for, your simple guy who isn't much into getting into calculations, but would still want to have a sense of this?
Of how long it will take them to increase their initial principal.
Yes.
I think you actually need to start from the basics. You have to still understand the investment that you're actually getting into, and the return that the market is actually offering. And you have to do that math with your relationship manager from the word go. You have to make that investment, understand, align your goals with that investment, and understand how long it would actually take you to actually reach the target. Start with the end goal in mind. If you are starting with a principle of 50K and you want your money to grow to 500,000 so that you can meet a target or a goal that you had set for yourself, start by talking about that with the relationship manager and calculate how long it will take you. So the whole point is just having the bigger picture, you know, and understanding the investment that you're getting into. Some investments could be liquid, others couldn't be liquid, others will take you longer, and others could take you a shorter time, especially the riskier investment assets.
Something I like about the rule of 72 is very simple. So it doesn't, you don't have to feed formulas in a sense. So it's 72 divided by your rate of return to get a sense of how longer it will take to double your money in a sense. So for 50,000, basically, like you said, divide that by 8 and you get a sense of divide that by 10 as the rate of return, and you need I2 over 7 years to double that amount of money. So is it that simple for someone? I feel this is the most relatable formula, because it's very easy. 72 divided by your rate of return.
I agree 72 is a very the rule of 72, they call it the rule of 72. It's the easiest rule for any layman or any beginner investor. You divide it's 72 divided by the interest, and you divide it as a percent. You don't turn it into a decimal. So for example, the 50,000 example with 10% interest would be 72 divided by that 10, and not divide by 0.1 and all that. So that is the easiest rule, actually. I agree with you. You just do 72, divide by the interest that asset class, whatever investment you're making, the interest that they're offering you. Just do 72, divide by that, and then see how long it will take you to double, rather than just going the investment with your own set time.
All right. So I would like to come to, in terms of now looking at asset classes that will give you the benefit of compounding, I would like to have a sense of which asset classes will now have that magic of compounding, that at the end of a certain period, my principal becomes the principal plus interest and in the former period, so that if I made 10% on my money this year, next year I'm not starting from my 50,000, I'm starting from my 50,000 plus the interest made on that year. Perhaps which are these asset classes that will give you that benefit?
On a broader tone, there are many assets that would give you or would allow you to use or leverage the compounding effect. There's stocks, there's mutual funds. But to go to the point, let's talk about unit trusts here in Kenya. The common, popularly known as money market funds. There are several of them, but the popular one is money market funds. So those are the ones that actually allow any beginner investor to compound their money, or to allow them to earn interest on top of their interest. And for money market funds, they allow you to earn interest on a daily, and then that interest is compounded on a monthly basis. When you talk about stock markets, when you earn the dividend, reinvesting that dividend would allow you to benefit from the compounding effect. When you talk about asset classes like real estate, the rental income, when you reinvest it, the whole point in these other asset classes, apart from money market fund, for you to enjoy compounding, it's about reinvesting those returns. But for money market funds, the benefit or the joy with money market funds is that, or the beauty with it, is that the interest that you earn every day, first of all, your capital is very safe. But the interest that you're earning every day is usually compounded at the end of the month, and it allows you over a period of time to for your money to just grow even without you watching it.
Watching or even adding to it.
Or
in a sense, you can even just leave it.
Yes, even without topping up, your money will still keep on growing. And your interest will keep earning interest on top of that previous interest. That's the beauty of it. And within no time, if you calculate with follow the rule of 72, you stick for that the number of years, you will actually double your income.
And I like the simplicity of the rule of 72, because a lot of time when you're telling people how to double your money, they'll actually think you're selling an outright scam. Yet, like you noted, it's just patience. It's just leaving it alone. If you don't need it, if you don't have to, there's this example always given about not watching paint dry. You can't sit around to watch paint dry, because it's going to take a long time, and you really get frustrated. You might think, maybe it needs a fresher coat or such and such. I get the sense it's the same thing. You don't want to sit around and watch paint dry, so sometimes you move away and watch that magic. I think we've spoken about money market funds previously here on the podcast, and I like the example. the best example to show the power of compounding. So I was thinking in terms of 50,000 earning at 10% per year, and you'd be making right around 5,000 shillings. Then your next year begins at 55,000 shillings. You earn again 10% on that, another 55 that's added again to the principal. And then you get to see that over time, stretched out over a period of time for sure. That's a good way to get that compounding effect. Now, I know you are in financial engineering. I don't know how much of behavioral finance you've tackled on, but in the modern times, there's that desire for instant results, no matter what it is. Investments, sometimes when cooking, you're frustrated, like, I don't know, your pot today isn't working best. Sometimes it's even an instant, say an electric kettle is just not warming up whatever you're warming as fast as you'd want. How do we get to achieve patience in investing in these modern times where it's a lot of instant results? It's a lot of, you want a faster computer, you want you want a faster phone, you want a faster processor, you want a faster refresh rate on your screen. You don't want to have to feel like your phone is lagging on. You want to check on your social media updates in a sense. How do we still achieve patience? Because like we've seen, you'll double your money. Left alone, your money will grow to infinity, for instance. Just noting. But you are confronting a time where people really want that result now, not tomorrow. I don't want Purity to come tell me, oh, you can double your 50,000 shillings in in 7 years and a few months time. You can actually double this investment because people really want that instant result. How do we still cultivate patience in investing, despite what is a very chaotic and a very modern approach to things where it's instant results, is instantaneous. Like you said, overnight success is what is glorified today. Nobody's glorified. Nobody wants to put in the work. Say you are 25 and someone tells you, you keep doing this, and at 35, you'd really be like, I'd really want that at 26, 27. I don't want to do this after I'm 30. I want this now, 10 years later. So the question then, how do we cultivate this patience for you? What do you feel is needed?
What I usually tell people, to add on the anecdote that you've used on watching paint dry. There's a famous African saying that says, a watched pot never boils. You know how when you're boiling milk and you're just there, you're watching it, it never boils actually. And then the moment you leave, that's when it actually boils and spills over, and then you have to start over again. So really, that's something you can reflect on. When you behavioral finance says or actually explains how human beings or investors are rational and they struggle with being patient in any investment that they make. And the situation is worsened in the era that we live in of social media. No one shows you the struggles or the time it took them to actually build the wealth that they've had. No one takes the time to think, and how did this person actually get to this kind of wealth? Everyone just wants the next big thing. And so I think the best way to move forward would be to shift our mindsets, and to actually understand that in investing, it's not about avoiding risk, because there's no investment that does not have a risk. All investments will either have a low risk, a medium risk, or a high risk. There's nothing like zero risk, So investing is about managing risk rather than avoiding it. Let's shift our mindset and understand that concept. Understand the risks in every asset class before you actually start investing in it, Make sure it aligns with your goals. See the bigger picture, play the long-term game. And studies actually show that long-term investors outperform short-term traders. I like to call those people who just they enter the market today, they make an investment today and they want to quit tomorrow. Those ones are traders. Those ones are not investors, and you cannot be a retail investor and you want to trade, surely. There's a lot of information that you need to digest. There's understanding the investment. There's a lot of due diligence you have to do. So you cannot make an investment today and then expect to be richer tomorrow. It's important for us to maybe embrace the buy and hold strategy. Buy and hold strategy allows you to give compound interest the chair and let it just work its magic.
Yeah.
You know, so you buy or you enter into the investment and then you just give it time. Time equals money in investing. The longer you stay in that investment, the longer the higher the potential of you actually maximizing your returns. So let us shift actually our mindsets and actually strive or endeavor to build a staying power kind of portfolio that is a resilient portfolio, you know, a portfolio that, I mean, we've had market crashes over the years, several of them from 1920s. There's always a lot of market noise. There's always a lot of market fluctuations. But at the end of the day, those investors that are able to block out the noise and stay in the companies or in the investments that they made because they believed in them, they're the ones who outperform the markets. Yeah.
All right, thank you. And I like the example you made about the African proverb where, you know,
I watched
what never boils. And it reminds me when you're cooking tea, sometimes you just go away and you'll actually rush back to turn it off because, you know, it boils up versus sitting there and it will never. You get the sense of time almost not moving.
Yes.
And so sometimes the best way is to move away and come check back on it later. So we've spoken about, you know, the justification for patience. And I know this is something we always told growing up, especially as children in you know, walking through primary and high school, that patience pays. Yet somehow it's not something we've embraced so much within investing. You know, we want to make a quick, you know, people talk of making a quick buck. I don't know, here we might say a quick shilling. But is it that for you, does patience pays in the end? Do you feel that?
Absolutely.
You know, we need to let time work its magic in whatever we are doing in investing.
Absolutely. I agree. Patience pays in investing. And when you listen to the stories of the people who have built sustainable wealth over the long run, they'll tell you they started by earning interest rates worth less than 100 bob. But it has taken them years and they've almost, they've doubled or tripled their interest. So the longer you leave your investment, the longer you stop watching it, the higher your potential of maximizing those the returns, you know. So patience really pays in investing.
All right, purity. Unfortunately, talking about time passes quite fast, and this is all time we had for the podcast. And I'd like to thank you for being on this week's podcast with us here, talking about the impact of time and, you know, time equaling to money here in a sense. And I think you've very much put this into play.
Yeah, thanks, Kefa, for having us.
All right. That has been Purity Wanjiru, research analyst and financial markets and investments at Abojani Investments. And I'd like to thank you again for being on the podcast. And remember, you can catch us across wherever you get your podcast from. businessdayafrica.com and nation.africa is where our podcast hits, but you can catch them all across the board wherever you get your podcast. And catch you next time. Thank you.